Welcome to The Explainer. All right, today we're jumping into a really common and, let's be honest, pretty frustrating problem in the world of retirement planning. Finding out you made an excess contribution to a Roth IRA in a prior year. If you've ever been in that spot, staring at Form 5329 and just wondering how on earth you fix an old mistake without making things worse, well, you are in exactly the right place. Let's get this broken down.
So here's our game plan. We're going to start with the basics, understanding the penalty that causes all the trouble in the first place, that infamous 6% tax. Then we'll pull apart the official IRS form, 5329, and see exactly how the math works. After that, we'll get into your strategic options, cover some game-changing updates from the Secure 2.0 Act, untangle the super important Statute of Limitations, and then, finally, we'll put it all together into a practical strategy.
Okay, first things first. Before we can even begin to talk about a fix, we have to understand the law that creates the problem. You can't solve for X if you don't know the equation. And at the heart of this entire issue is the 6% excise tax. It's a penalty that's designed to be just painful enough that you really can't afford to ignore it.
And the Internal Revenue Code, well, it's incredibly specific about this. An excess contribution isn't just some vague mistake. It is a clearly defined violation. If you look at Section 408A, the code says that any dollar, literally any dollar, you contribute over your legal limit, which, is based on your age and your taxable income for that year, that dollar is officially an excess contribution. And that's not just a label, it's the trigger for everything that comes next. And here it is. This is the number that drives this whole process. Under IRC Section 4973, the IRS hits you with a 6% tax on that excess amount. But here's the part that you absolutely have to remember. It is not a one-time thing, not at all. It gets assessed every single year that extra money is still sitting in your account at the end of the year.
I mean, the regulation here could not be clearer. And the key word is right there, annual. This isn't just a simple slap on the wrist. It's a compounding problem. A single mistake you might have made years ago will just keep generating a new tax bill, year after year after year, until you take very specific, formal steps to correct it.
So you're probably wondering, how does the IRS actually track and collect this recurring tax? Well, it all happens on one very specific form, Form 5329, Part 4. And let me tell you, understanding how this form works line by line is the absolute key to getting this problem solved.
Okay, so the first few lines of Part 4 are really all about dealing with the past. Line 18, that's where you carry forward the uncorrected amount from last year's form. It's the ghost of the original error. Then you have lines 19 and 20. These are your main tools for making that ghost disappear. Line 19 is this really elegant method called absorption, where you basically use this year's available contribution room to soak up last year's mistake. Line 20 is more direct. You just report the principal you physically took out.
Now, this next section of the form, this is where it all comes together. Line 23 is for any new mistakes you might have made this year. Then, line 24 does the math. It adds any leftover excess from prior years to your new excess and creates your total tax base. And finally, line 25 hits you with that 6% tax. But, and this is really important, it comes with a crucial safety net. The tax is calculated on the smaller of your total excess or the fair market value of your account. In a year when the market's down, that little detail can actually provide some pretty significant relief.
Okay, now that we see exactly how the IRS calculates the tax, let's get into strategy. How do you actually stop this penalty from coming back every year? Well, you've got three primary paths you can take. And believe me, the one you choose has some major tax consequences.
So everything really hinges on one thing, the deadline. We're talking about your tax filing date, including any extensions. If you catch the mistake and act before that deadline, you get to make what's called a timely correction. This means you pull out the excess contribution plus any earnings it generated, what the IRS calls Net Income Attributable, or NIA. Now, that NIA is taxable, but the big win is you completely dodge the 6% excise tax. If that deadline flies by, you're in untimely territory, and that 6% tax for that year, it's locked in. No getting around it.
So once you're past that deadline, you've got two main plays to fix that old excess contribution. First, you can just physically withdraw the principal amount. This stops the penalty clock immediately, but it does mean you're going to have to deal with a 1099-R form. The other option is that absorption method we talked about. It is way simpler administratively. It's just a number on a form, but the catch is it eats up your ability to contribute for the current year. So it's a very direct trade-off. Do you want the administrative hassle, or do you want the opportunity cost?
Now, just when you thought you had all this figured out, Congress went and changed the game.
The Secure 2.0 Act of 2022 rolled out some of the biggest changes to these rules we've seen in years.
This act gave us two massive pieces of relief. First, Section 333 completely got rid of that painful 10% early withdrawal penalty that used to apply to the earnings on a timely correction. That was a huge win. It makes the best-case scenario even better. Second, and this is arguably even more important for these old mistakes, it created a brand new 6-year statute of limitations. This completely changes the timeline for how long the IRS can even look back at these kinds of errors. And this new statute of limitations, it is an absolute game changer. But, and there's always a but, right? Its power is limited by a key court ruling that every single professional in this space needs to understand.
I mean, this is a night and day shift. Under the old rule, which was established in cases like Paschall v. Commissioner, the statute of limitations clock for that 6% penalty never even started ticking until you filed Form 5329. Think about that. It created this state of indefinite liability. The new rule in IRC Section 6501L4, though, it changes the trigger. Now that 6-year clock starts ticking when you file your main Form 1040 tax return. That provides some much needed certainty.
But here's the critical limitation. The 2024 tax court case, Couturier versus Commissioner, it settled a huge question. The court ruled that this new, much more taxpayer-friendly statute of limitations, it's not retroactive. It only applies to tax returns filed on or after December 29, 2022. And what that means is that any older, uncorrected, and unreported errors, they're still exposed under that old Paschall rule of indefinite liability.
Okay. Whew. We have covered the tax, the form, the correction methods, and the new laws. That's a lot of technical detail. So now let's put it all into a practical decision-making framework. How do you actually choose the best path forward in a real-world situation? Well, this matrix here really simplifies the choice based on how big the error is and when you found it. Look, for a tiny excess, say a couple $100, the administrative ease of absorption is often worth it. You're avoiding paperwork for what, a $12 a year tax? Probably a good trade. But for a large excess, maybe $7,000, stopping a recurring $420 annual tax by making that untimely withdrawal is almost always going to be the better choice. And of course, if you catch any error before the tax deadline, timely correction is the gold standard. It's the best option, hands down.
And that right there leaves us with the most important takeaway from this entire deep dive. While Secure 2.0 is fantastic and gives us welcome clarity for the future, that Couturier ruling confirms that it also shines a bright and pretty uncomfortable light on the past. The fact that the new rule is not retroactive means that for any returns filed before the end of 2022, there could be potential indefinite liabilities just hiding in plain sight. So the real question for every professional now is, how are you going to reassess those old filings?